Hello, everyone. I'll look at chapter 19 today. The title of that, as you can see, is Accounting for Employee Compensation and Benefits. Now, I could literally talk for hours and hours about this chapter. So much going on here, but we'll have to obviously make this rather brief in the next hour to talk about some of the important parts of this. And when we look at the various parts of this chapter and how we're going to break this out, let me just go here to the notepad. That might be better for me just to put sort of a big picture of what's going on in this chapter. Find my smart notebook. There it is. We're looking at a big part of this chapter on stock options. And a lot of this it can be classified either as equity-based options, and then also what's called liability-based options. This includes, well, this does include also what's stock appreciation rights, which really ought to be up here under the equity. SAR really ought to be up here under equity because it is based on equity. I don't know why they break it out separately, but they don't. And we're also going to look at restricted stock plans. Employee stock ownership plans, although, and I'll talk about that later. It's not that important topic in this particular chapter one, from the standpoint of trying to focus on the most important parts. But we're going to look at equity-based, liability-based stock options, also stock appreciation rights, which is sort of separate from these other two, and then restricted stock plans. The other half of this chapter, if you've got that, the other half of this chapter is all about pensions, what we all want, especially when we get older. Pension plans. And under pension plans, you've got what's called a defined contribution plan and defined benefit plan. Wish I had a big board to write on, but I don't. Defined contribution versus defined benefit. Tennessee has what's called the CCRS, Tennessee Consolidated Retirement System. And it is based on number of years worked times, used to be your 5 highest salaries averaged times a factor, which is usually around 1.5%. So you can see with the defined benefit plan, which becoming fewer and fewer, if you go back 30 years ago, majority of corporations had defined benefit, but now it's flip-flopped. They all have this defined contribution, which I'll talk about here shortly. But the defined benefit plan, take for example, if you put in 40 years for the state of Tennessee, ETSU, times, let's say you end up averaging, I don't know, 100,000. Your 5 highest salaries in the last 5 years was 100,000. Times 0.015 tells you what your annual benefit's going to be. And that is what? Looks like $60,000 per year. Pretty good retirement. But it's based on your 5 highest salaries. That's why it's important as you go through your career. If you get in a situation where you making good money just in the last 5 years of your career, you're going to have a great retirement. Now, this has changed somewhat because July 1, 2014, this used to be non-contributory. Non-contributory. What's non-contributory? ETSU prior to July 1 of 2014, they would put in the entire 14% of your salary with the state of Tennessee. If you've been hired since July 1 of 2014, the ETSU or whatever state agency you're working for is going to only put in 9%, and you have to put in 5% out of your salary. Big change. 5% divided by 14, what is that? About a third. So now people who are retired or in the retirement plan in Tennessee have to put in 5% of their salary. They have to fund it by 1/3. In addition to that, this is still in play, except the factor now is like 0.01. They've cut the benefit by 1/3. So you're paying 1/3 and your benefit's been reduced by 1/3 if you've been hired since July 1 of 2014. If you're prior to that, you were grandfathered in. That's a change. Other companies have done away with it entirely because why would they do away with this? It's complex. It requires separate audit. It takes a lot of time. You have to use an actuary because this whole plan here is based on how long our individual's going to live. And they have tables that no matter what your age is, if you're 90 years old, they know what your likelihood of living to the age of 95, which is probably your expected longevity at 90 is 95. So all these tables, you have to put in on your books what your projected benefit and your projected obligations are. Very complicated, but we'll look at that in the last half of the chapter. But for the most part, these plans are going by the wayside. If you're in one of those, you're fortunate, especially if it's being funded entirely by someone else. The simple plan that everybody's adopting, including a lot of corporations, is defined contribution. Now, some that have defined benefit, they'll have this defined contribution as well, like a 401k or 457 plan, where you put in just a flat amount of money and then the company will match that. ETSU, if you decide to do the defined contribution, because since I was hired since July 1 of 2014, I opted out of this and do what's called an optional retirement program, ORP. It's still part of TCRS, but it's separate in the sense ETSU puts 9% of my salary into a mutual fund that I decide which one, and then I put in 5% on top of that. So that's a defined contribution plan. Very simple. They don't have to try to determine when you're going to die and what the obligation to pay me till that particular age. It's just in a mutual fund, and based on how the market does, if it goes up or it goes down, determines how much I've got in a lump sum that I can use at some point. The market's going up over time substantially, like it has, well, until February this year. It's gone up since 2009, an average of 16% per year, but that's way beyond the norm of 6.5%. So it has advantages from a personal standpoint, but also primarily from a corporation standpoint. It's very easy to administer this. Take money out, send it to Fidelity or Vanguard or whoever you have relations with to fund your retirement. Non-contributory, again, this down defined benefit, it can be contributory like it is now. It's not contributory if you were hired prior to July 1 of 2014. Now it's contributory. You have to put in 5, your agency puts in 9. This up here can be contributory and non-contributory. Again, ETSU puts in 9, I put in 5. If I'm in their 401k plan as well, if I put in $50 a month into a 401k plan on top of this ORP, if I put $50 in, ETSU will match it with $50. So that's a contributory. So contributory and non-contributory are sort of topics that the book uses that are really for both of these plans. But we'll get to that as we go through here. See, I told you I'm going to talk for a long time about this stuff. All right, so let's go back and look at the PowerPoints, and I'll try to be as quick as possible going through these, and then we'll look at the homework in another video. What we're doing here, again, following the format, employee stock options. What are employee stock options? Those are gifts, for lack of a better term, based on driving performance of the corporation, usually for key for key individuals in the company. Usually everyone doesn't get that unless you're a high-tech company that has a lot of employees that you can't afford to pay a big salary. You give them stock options, meaning as the stock value goes up, you make a lot of money, which may or may not be taxable depending on when you sell or exercise those options. But stock options is a way to incentivize, if that's a term, incentivize employee performance to drive the stock price up. And how do you drive the stock price up? You drive earnings per share up. That's the whole point. That's what this chapter is. You can see there some of the information about various plans that Fortune 500 companies have. Obviously, a lot offer stock options, although they're not available for just the average person. It's usually for your key drivers of performance. Stock options or call options. It's a right, it's not an obligation to purchase stock at a later date. You're not going to exercise those options unless the stock price is beyond what's called the strike price or the exercise price. So don't think this is really all that difficult. I mean, there's a lot of terms here and there's a lot of different terms for the same thing. Exercise or strike price, that's the amount at which you're going to exercise your options. And of course, unless the market price of the stock is beyond the strike price or the exercise price, those options would never be exercised and they would expire. And we'll see what we do when those options expire. Now, the whole point of having stock options for individuals is to drive performance where there's a vesting period or service period. You want a period of time that employees, these key employees, are driving positive performance. Maybe it's 2 years, maybe it's 3 or 4. And over that period of time, that has to transpire before these options are eligible to be exercised. And hopefully during that period of time, earnings have gone up, stock price is rising because of those earnings. Remember, PE ratio goes down when the earnings per share goes up. And when the PE ratio goes down, more people buy the stock, more demand for the supply. Stock price goes up, then they would want to exercise these options. Expiration date, employer can no longer exercise the options, and so compensation arrangement as well states what's the number of options granted to each individual, what is the exercise price, what's the vesting period, and then after the expiration, which might be 2 years, maybe these expire after 4 years or 5 years. Okay, the exercise price, as we go through these exercises, you're going to see the exercise price is the price that if I'm the person with these stock options that haven't been exercised, I'm not going to exercise unless the market price is above the exercise or strike price. So the exercise price is $10 a share, and then the market, for whatever reason, the stock I've had some impact on driving earnings per share. If the market price of the stock is $20, the strike price is 10. If I'm able to exercise those options, I'm going to do that. But I have to pay $10 per share for those options. I have to pay the corporation that. So don't think I'm just giving this and then I just go out and sell these options. I have to pay $10 per option to get these options that are worth in a share of stock if it's one-to-one relationship for a $20 share of stock. Well, I'll gladly pay $10 for something that I can sell for 20, right? But keep that in mind. These options aren't just without a exercise price that, as it says here, the employee will exercise his or her option when the current market price of the stock exceeds the fixed price, right? Stock exceeds the fixed price, exercise price, or strike price. A lot of conceptual stuff here about how you come up with stock compensation, because that's what's unique about this. As we get into this is there's some value associated with this that the employee is creating. And so in essence, what we're going to see in this equity-based stock options, which is the first part of this, is we're actually going to create an account called deferred compensation, which is a contra equity account. Contra equity has what balance? Debit, right? All equity has credit balance. This, in essence, we are going to create a contra equity account. All right, keep that in mind, because we're going to create a contra equity account. Very unique. How do we determine that? Well, fair value estimate, there's all these models out there. Black-Scholes, if that's the way you pronounce it, most commonly used. It's like a black box that generates numbers that somebody's come up with future values and so forth. That's where accountants get nervous about stuff like this. But this is something that's accepted. They use a couple of binomial and lattice model, preferred but not required by FASB, who really promulgates the gap for us. But we're going to allocate out of this deferred comp to what? To compensation expense over the service life, over the service period. You'll see that as we get through this. I mean, I can talk about this all day, but it's really not going to make a lot of sense until we look at it. So the first section that I put on that whiteout board here just a second ago was equity-based or equity classified stock-based compensation. All right, they make it rather complicated here and where they just describe it. You got to know what the fair value of that is, which again, that's given to you in this class. You don't have to worry about how finance or advanced accounting. It's not even advanced accounting, it's well beyond that, of how do you come up with these values. But we're going to debit, as it says here, a contra equity account, deferred compensation, and then we're going to credit additional paid-in capital, stock options. So we've just pulled numbers out of our equity, right, in a sense. Usually makes accountants nervous when you do that. And that debit to deferred compensation, as the service period goes on, we're going to credit deferred compensation and credit compensation expense. So you're taking this out of your equity and taking it to the income statement. No net impact on the balance sheet, right? If you're reducing equity, right, with deferred compensation, debit, and then you're crediting additional paid-in capital stock options. It's like capitalization of retained earnings with stock dividends. Do you remember that a few chapters ago? We debited retained earnings and credited common stock. It may go on the common stock dividend distributable first, right? But in essence, it goes out of retained earnings and into common stock when you have a stock dividend. Similar to what you're doing here and how you're creating these accounts. Okay, so let's look at this first example. Davis Enterprises, stock options. Don't care about par value. Exercise price is $5.10. $5.10. That's where pretty much you start, and that may be the value of the stock or the market price of the stock when this is created. But the whole point of this is you want the people who are getting these stock options to make that stock price go from $5.10 to $6.10, and then $7, and then $8, and $9, and so forth. Very important. Kind of like if you've got stock options from Google back in 2004 when they went public, stock price was selling for $100 a share, went all the way up to $1,400 and split 2 for 1. All right, you can see how exercising, if you had stock options back then with Google, if you were one of their employees, how they become multimillionaires from the fact they had equity stock options. But back to this, it says they must complete a 2-year service vesting period, 2-year vesting. All right, so we're thinking when we take this, make this journal entry out of my equity, we then are going to take that amount and reduce it to 0 over 2 years. That's what the vesting period is, deferred compensation. Debit to deferred compensation, credit to APIC stock options, and then we're going to credit over that 2-year period, deferred comp and debit compensation expense. All right, to tell you what the fair value of these options are, they think it's worth $576,000. You don't have to worry about where that comes from. They think it's $9.60, it's intrinsic value. All right, so what does that look like? Well, $576,000 over 2 years, you're going to recognize compensation expense of $288,000 for each of these years. Going to your expense, going to your income statement. The first entry we're going to make, these are equity accounts. Both are equity. So you're taking out of one equity account, deferred comp, $576, and putting into APIC stock options. These are both equity accounts. Very important. Got to know where the accounts are. These are both equity accounts. That's when these options are at the date of grant. They can't exercise them yet. They got to put those 2 years in. So each year, what are we doing? We're taking $288,000 out of this deferred comp, right? 288, and then 288 down to 0. And all that's left is my 576 sitting there in APIC stock options, waiting for them to be exercised. Things can change each year, and in this particular example, what happens if it's estimated employees only exercise 60% of the options? Maybe 40% of the people you gave the options to have left the company. Maybe the value of the stock is not going to be what they thought it was going to be. I don't know. There's going to be a lot of different reasons, mainly it's because people leave. And when that happens, if only 60% is relevant now, we need to make an adjustment, don't we? So that 576, we've already put 288 in. 345, if that's the total amount, we're at 345, then we in essence need to what? Make an adjustment of what? 288,000, or excuse me, 57,600. So we in essence are going from, where's my chart? This was deferred comp, and we started out with 576, 288 came out, and now that 576 is actually supposed to be what, 345? Well, this is going to be what, 57.6, which gives you a balance of 288. Is that right? My number's that up. What is that? That's 345.6. So 345.6. So we've got a balance there we got to do something with, don't we? 345.6 from 576. $230,400 balance. We're going to have to make a journal entry there for $230,400 to make that 0. I think they show that to you later, but we'll see. I know we have this in some of the exercises. And there it is, they do it. All right, so there's your adjustment that's going to have to be made, the $230,400, because remember, you got your, I don't have room to show that here. Now you got your APIC sitting over there, right? It's just sitting there with 576,000. Well, if this number is supposed to be, what would you say, 370, 345.6? If that number is supposed to be 345.6, how do you true this up? I haven't said that lately. You got to make an entry here for 230.4, don't you? Get from here down to here. We've recognized that expense, 345.6, right here, haven't we? 288, followed by 57.6. That's what's gone to our income statement. 345.6. And now our deferred comp is gone, but we got to make an entry to zero out deferred comp. That's got to be 0 at the end, because it all has to go to the income statement. These dollars that we've put in there have to go away. It has to be 0. So if I'm debiting, excuse me, that should be over here, right? I put that in the wrong place. Deferred compensation, $230,400. Stock options has to be reduced. Put my deferred comp here. So deferred comp was 576, right? And we've had 345.6. This leaves me, no, I had it in the right place. Yeah, I should have left that there. That's okay, because there's my journal entry to remove it. I was looking at the wrong thing. All right, so there's my balance. So I've got to zero that out, don't I? 230.6 to make that 0. All right, right there it is. And my stock options have to be reduced to 345.6, because that's what's relevant. That's what can be exercised. And And then there's my compensation expense for year 2. So that 576 can be adjusted. Don't think that once you cast this in stone, it's in there for 2 years and you can't change it. You can. It can be changed. And I just showed you how you would do that. All right, there's an even better way. You can probably read it better. There's my 576 deferred comp, contra equity account. 576, there's the 288 for 2015. There's the remainder for 2016. But what? We've come to find out that it should only be 288 plus 57. So the 230,400 needs to be zeroed out. There's my compensation expense. Gone to my balance sheet, or excuse me, gone to my income statement. And there's my stock options balance. All right, deferred comp is 0. That's all that's left, sitting there in my equity. I've taken this equity and I've taken it to my income statement. That's compensation expense. So now the 345.6 waits until options are exercised or what? Expire. Then you have to take it out of there and do something with it. To expire, you just debit APIC stock options for 345.6 and credit APIC stock options expired for 345.6. If they're exercised, you're going to debit, but we'll see. We'll get there. All right, so these are equity classified awards. All right, they're either going to be exercised or they're going to expire, like I just said. And then expiration, there it is. From APIC stock options into APIC expired stock. A very simple journal entry. All right, what about an option exercise now? Davis Enterprises granted stock options on January 1 for 60,000 shares for, that looks like $1.20 per share. The estimated forfeiture rate was 0, so there's 100% vesting. Estimated fair value of the options, 576, so they're using the same information, good. All right, what is the journal to record the option exercise? All these options were exercised on January 2nd, 2017. All right, which is 2 years. 2-year vesting. All right, so I guess there's a solution. Let's look at this. All right, so the stock options, they don't actually show the actual initial entry, do they? They're just showing what happens when you actually exercise those. So that's fine. So we're going back to the previous exercise that we kind of worked through, but assuming that the 576 didn't change. We didn't take the 60%. We're assuming they went all the way through 576,000. 288,000 was expense. So if I put that on here, this is before this. Compensation expense 288. Deferred comp. And then the second year, deferred comp. That's the assumption before this. All right, I'll make that clear. So now the 2 years are passed and they exercise these options. So this increase in cash by 306. So where's the 306 come from? Well, let's just look on here. 306, that's the exercise price times 60,000, right? That was up here, right here, 60,000 of $1.20, forget that, 60,000 shares. There it is, exercise price 510. So 60,000 by exercise price means that's the cash that your holders of these grants, these stock options, your key executives have to pay you. They got to pay you 60,510 to put this on the books. So that's what that is. 60,000 times 5.1. Debit to cash, because they're going to write a check to you, or ACH. You're going to get that much cash. You're going to now zero out your stock options, right? Remember, your stock options are sitting there. Stock options, APIC, or APIC stock options, sitting there at 576. If all of these options have been exercised, you got to get that off your books as well. Deferred comp's already been zeroed out, right? Deferred comp's gone. Now your stock options APIC is gone. There that is. So what do? Well, that's 60,000 times par value, which was what, $1.20 par is 72. And what is that number? That's a good old plug number, right? These options have been exercised. You're done. As a corporation, now it's up to the individual who has these options. Are they going to exercise them currently, or are they going to hold on to them? There's a lot of tax considerations there about how long you have to hold them, probably a year and a half, before something becomes long-term capital gain versus paying in ordinary income tax rate. I think it's a year and a half. All right, good exercise there. Second part of this, what if these options expired? What if the stock price, because in this case, the stock price was what? $5 and, or excuse me, well, it doesn't say, does it? It just says these options were exercised. I mean, it doesn't matter to you as a corporation making this entry. What the stock price was $100 a share. Yeah, they're going to exercise them. But it tells you here that they exercise these options. But what would the amount have to have been for them to exercise these options? More than $5.10. Maybe it's $5.11. Make a penny on each share, right? $6, that doesn't tell us. We just know they exercise them. But if you go through, and I don't know what the end period is, 5-year option period, there it is. If there's a 5-year option period, then now you've reached the end of 5 years, the stock price is never got above $5.10. Nobody's going to pay you $5.10 for something that they can sell for $4, are they? No. So if you get through that 5-year period without these being exercised, they've expired. And what do you do when they expire? You don't go back and make journal entries correcting all the stuff you've done in the past. It's a good faith estimate. Everything should be okay. You did what you should do, but you do take that out of expired stock options, or excuse me, you take it out of stock options, right? Which has been sitting there with that 576. What are you going to do? You're going to take it out of that with a debit, make that 0, APIC, stock options, and you're going to put it to another equity account called expired stock options. It's just a way to highlight that there were options out there at some point and they were never exercised. All right, very simple. All right, so that's equity based, right? All that transactions were out of the equity account. What if it's liability based? You know, with equity, once those options are granted like that and they're exercised by an individual, it's all on them. What they do with those options, doesn't matter what the stock price does, it's theirs. That's the nature of selling stock, right? Going back to chapter 15. It was the equity chapter, yeah. Chapter 15, risk of ownership. When you sell your stock, you're giving up equity, but that risk is on the holder of that stock. And they don't sell it back to the company unless the company's doing a buyback, treasury stock. But you recall in chapter 14 with bonds, with a liability, when I sell those bonds, more or less giving a loan to other people and other companies that are buying my bonds, I have an obligation to pay them back for the money that they gave me, right? Well, that's similar to what you're seeing here with liability classified stock-based compensation. Liability-based. So, because in this case, if you're the holder of liability-based stock options, you have that option to sell it back to the corporation. Let's walk through this as well. Liability classified award. Boy does not absorb any risk, right? Compensation is form of stock appreciation rights for the employee receives. Cash for the amount of the increase in share value. Well, that's a kind of a separate issue from, I don't know why they put that in here like this, but SARs are something we're going to look at, but it's a little bit separate from just a basic liability classified option. Stock appreciation rights is when the stock price goes up a certain amount and they're rewarded for that, separately from what you see with an option. Pay attention to this. Company is not making entry at the grant date. Remember the entry we made the grant date for equity-based, debit, deferred compensation, credit, stock options, APIC, or APIC stock options. You don't make an entry at the grant date, but you are going to make an entry at the end of each year to compensation expense. Here you're going to debit compensation expense and credit the liability. That's what's different about it. They don't say that here, but they will shortly. So here we've got ALR, granted employee stock options on January 2nd, 2015, for 100,000 shares, dollar par value common. That only comes into play when you actually exercise the options. Exercise price of $25, meaning they want the stock price to be north of $25 in order for these to be exercised. The market price was also 25. So you can see they want you to make the stock price go up. That's the whole point of stock options, whether it's liability or equity based, or based or classified. Estimated fair value of the options using the Black-Scholes option pricing models, $30 per share. So they think that's the value of these options. Again, kind of a black box how these numbers come out, but you don't have to worry about that in here. $3 million. So that says $3 million. We want to expense that over, what did it say, 2 years? 3 million divided by 2. So we're going to record expense of 1.5 million each of the next 2 years. There it is. Journal entry side by side, 2 years. Compensation expense, liability. So we're setting up a liability at the end of each year. Nothing at the beginning. And you do the same thing that you do with equity based as far as adjusting. If people leave, stock options aren't relevant anymore, you have to make adjustments for that. You can see with a small startup or something where maybe things don't look good the first year, people may leave, and lo and behold, the next year things look great and they get exercised. That happens. So you can adjust that compensation expense, similar to what you do with equity based. I got to tell you, the liability classified journal entries are a lot simpler to understand than the equity. You struggle with one versus the other. So what they're saying here, it started out with 3.2 million, and then they're saying it should be 3,125,000. So what should those entries be? And here they're saying the value or the output from this Black-Scholes model has changed. It's 3,125,000. Maybe it's not because people have left. Here they're saying the model has changed. So they want to make an adjustment here. They've already recorded 1.6 million. I don't know why they changed it from 3 million to 3.2, but they did. The 3.2 million is the total for 2 years, 1.6 million, but then the next year they decided that it's 3,125,000, right? Well, if I've already made a journal entry for that, then the next year, my journal entry would be that. So those are my two compensation expenses. You don't have to worry about adjusting that APIC stock option. You don't have that out there, right? You don't with liability based. That's why this is a little bit simpler than equity based. And so that's what those two journal entries would look like. This being adjusted based on new information from the Black-Scholes, that's what it's called, model, or binomial. I don't want to call it binomial. I guess it's binomial. All right, what about the exercise of liability classified? Because we saw what we did with equity. based. What do you do if we exercise these awards, or what do we do if they expire? Similar to equity classified, although a little simpler. For any cash receipt, again, your executives are going to pay you for these options, right? Like they paid $5.10 for those 300,000, 30,000, whatever it was, 60,000 on the equity based. They're going to pay you for these as well. So you remove the liability, right? Recording cash, so you're debiting cash. You're debiting what? The liability. And then you're going to what? Stock issuance, common stock at par, and then you're going to have additional paid-in capital as credits. What if it expires? Company removes the liability and records the amount of APIC retired, stock options. So whatever that liability for whatever it's called, liability for stock options, whatever that is going to be debited to remove it to zero. And then you're going to have this APIC, which you've never put anything in there for liability base to begin with. You're just going to put that to retired stock options if they expire. So they kind of end up in the same place, liability based if they expire. And same way with if they're exercised, you end up with what? A credit to common stock at par and a credit to additional paid-in capital. So the end result is the same for these stock options because they are stock options. It's just, are you handling through the equity-based method or equity classified method or through the liability classified method? So let's just walk through here. It looks like we've got the exercise of these options. Now they jump back to where it's not 3.2 million, or they've jumped back to the original amount, right? 3 million, keep you confused. 3 million, so that's what's sitting out there as my liability. 1.5 million for each of 2 years. There's the cash that has to be paid for these options. There's common stock at par, then that is my plug number. 5.4 million. And if they expire, there's the entry for it being expired. Debit liability at the bottom. Credit, equity. Liability, equity. Not too bad, just stuff to remember. All right, so now we're to the stock appreciation rights, which is really kind of sort of liability based. I don't know why they do it separate. It's really liability based. But then you got this restricted stock plan, which is an entirely different animal, which is really more equity based. You'll see why as we go through this. And then employee stock purchase plans, don't worry about that. I wrote that on that other screen, but I never test on employee stock purchase plans. That's just where a company will buy stock for you through their company stock for you at a reduced or maybe no charge at all as far as brokerage fees. And you may even be able to buy partial shares. But don't worry about that because it's really nothing that you have to, the journal entry would be so simple. But stock appreciation rights and restricted stock plans, those are two things we need to go through. They are important. Stock appreciation rights. It's kind of like a bonus, as they say here, a bonus tied to the stock price of the employee shares. So they compensate the employee for the increase in stock price over a pre-established price. Very simple, very effective too. If you're giving these stock appreciation rights and the stock is selling for $100 a share and end of the year it's up to $110, you're going to get $10 per share, the $10 times however many rights that you have. But normally it's not a 1-year thing, it's going to be a 3-year. So what do you do as far as if it's a 3-year process, you're in it the first year, you need to make, if you're thinking like an accountant, you're thinking if that stock went from 100 to 110 in the 1 year, I need to make a liability for that donut. And then the next year, the price might be 90, then I need to do what? Remove that liability. So that's what is interesting about stock appreciation rights. That's why I think it's really liability based, although they pull it out separately. They're not options. These are just rights. And that may be why they don't have it up there in the liability based section. I'm just thinking out loud. All right, so here's a good example of Spitfire Motor share appreciation rights, granted 30,000 rights to its executives, receive a cash payment equal to the difference between the pre-established price of 25 and the market price. So at the end of the first year, it went up $29, didn't it? So they've made $4, although it's not the end of the 3 years. They're not going to get $4 at the end of the first year. They want this to be long-term, so you don't have short-term decisions driving bonuses. Should be long-term. But you, as an accountant, have to make an accrual for that $4 for 30,000 rights. Then the next year goes up, what, $3 more? So now you're $7 up, but then it drops all the way back to 28 at the end. So at the end, at 3, you're only going to pay 3 times 30,000. Too bad, right? But that's the whole point of driving the stock price up over the long term for the right reason, not short-term decisions. All right, so look at this chart here, very, very clear. There's the rights, or excuse me, 30,000 rights. The price is up $4, so you got $120,000 potential payout 2 years from now. Well, I'm not going to put the whole 120,000 out there, but I need to put 1/3 of that because you're 1/3 through this. So 33% of 120 is 40. So I'm going to make a journal entry for $40,000, right? Then the next year, all the way up to what? 7 times 30, 210,000. All right, 2/3 of that, because I'm 2/3 through this service period. I can call it service period. So 2/3 of 210 says I should have 140,000 on my book, shouldn't I? Well, I've got 40, right? I've got 40 sitting out there as a liability. Now that number should be what? Should be 140. So I need to what? Put 100,000 for year 2. Year 1, year 2. Then when you get down to the end, how much am I going to pay out? 3 times 30, 90,000. So 90,000 is going to be my actual liability. So then I need to what? Remove 50 from my liability because I'm only going to pay 90. When I pay the 90, I'm going to what? Debit that to make it 0. And the credit is to cash. Very straightforward. There we go. So there's my journal entry. Debit compensation expense 40,000. There it is. Obligation under SAR plan. Liability. The liability. This is liabilities. That's expense. Income statement. Liabilities on my balance sheet. Next year, there's my 100. I'm truing this up. 2/3. This is 1/3. I got to have 2/3 of what I think it's going to be. I don't know what the future holds. It's 2/3 based on the current price. And then this should be my accrual for 3/3, the full amount, which is 50,000. Well, not 50,000, it's 90,000, right? So I have to adjust, I have to reduce that obligation under the SAR plan by 50,000 to get it to what? 90,000. That's what I'm going to pay out, 90K. And then there's the payout, my 90K. That's what I was trying to show you right there. Ran out of space. 90K down here at the bottom. There's the payout. Debit liability, credit cash. All right, so that leaves one more thing before we get into the pension. This is long session. Restricted stock plan. All right, this is when a company awards, and this is really equity based. So the SAR is liability based. This is equity based. Allocation restricted shares to the designated employee. All right, here we got Newton Big Newtons factory issued 10,000 shares. Unrestricted shares currently have a market value of $30. The restricted shares vesting period of 3 years. Wayne Smith. Prepare the journal entries for that. All right, there we go again. Deferred compensation, restricted stock. It's not called stock options, is it? Like we did on that stock options a minute ago, and the first thing we looked at. We are creating equity account. We're debiting deferred comp, and we're going ahead at the very beginning and putting common stock at 10,000 and additional paid-in capital at 290. So this stock has been restricted. In essence, we had created this stock and we put it into deferred comp. Well, you know what's going to happen to deferred comp? We're going to what? We're going to expense that to the income statement, just like we did back at the beginning with stock options. All right, but this is restricted stock. This isn't stock options. This is restricted stock. If you make it through the service period without leaving or being fired, then you're going to receive this stock, whether it's a penny a share or $100 a share. They don't have to pay anything for it. It's theirs. So it doesn't matter what happens to the value. So each year we're going to debit compensation expense, 100,000, reduce that deferred comp by 100. Do that each 3 years. Each December 31. 3 times we're going to do this. So deferred comp is now 0. But they say here now that this person actually quit or was terminated. So what happens when they quit? Well, you got to take that off your books that you set up there 2 screens ago, right? That right there. We want to get rid of that. How do you get rid of it? Well, you debit those accounts right there. All right, you're 1 year into it because what I just showed you there was irrelevant. That's what you did for year 2 and year 3. This guy quit or was fired after year 1. So we get rid of that. We have what? A $200,000 balance in deferred comp. Remember, deferred comp had 300. First year, we wrote that down. The income to compensation expense, so we got a balance of 200. Well, we got to get rid of that 200. So we got to, there it is. Credit deferred comp, it's 0 now. What about this compensation expense? That was a prior year. Interesting enough, you don't reopen the books or make a prior period adjustment. You just take that in current years against current year's income. Interesting. But that's what you do. Compensation expense, you just credit that. But again, that was from last year, right? That was last year's. Employee stock purchase plan, we don't worry about that. Disclosures, a lot of stuff about disclosures. Let's get to the pension. All right, I've talked a little bit about this already, so I don't know how much I need to talk about it here now with the essence of time. I'm not quite sure what time I started this lecture, and Zoom doesn't tell me. Of course, you can just shut it off if you're tired of listening to me, right? But you might learn some life lessons through this. You never know. Defined contribution, defined benefit. Contributory versus non-contributory. Are you required to contribute or not? Again, I gave you that example of ETSU and just the state of Tennessee in general. Tennessee's got one of the best pension plans in the nation. I think they're ranked 4th. We are ranked high in some things. 4th in the nation as far as the pension being funded. That's going to change a lot with everything going on with the stock market, the bond market, especially places like California, which are upside down to begin with their pension. But Tennessee, I believe, is 4th in the nation. So why they changed the plan 6 years ago, I don't know. I guess they've got a good plan. They want to make it even stronger, expecting the worst in the future. And apparently the worst of the future has shown up now here in 2020. But the plans are contributory. Most plans are contributory now. Defined contribution. Defined, that means it's defined how much you put in. I defined to put in 5%. And ETSU is putting in 9%. So the defined contribution is they're putting in 14%. The defined contribution is 14%. It's defined. That 14% is going to a mutual fund of my choosing. 5% is what? Contributory. 9% non-contributory. It's a good way to relate those two together, right? When you talk about contributory versus non-contributory, these are mingled together. And the same is true for a defined benefit plan. You've got contributory and non-contributory, whether it's a defined benefit or a defined contribution. All right. If it's a defined contribution plan, what it says there, no pension asset or liability on the balance sheet. That just goes to a mutual fund. It's on the individual. It's up to me. I get a statement every month or whatever, look at it online. ETSU doesn't care what's out there. That's my responsibility to invest it wherever I think it should be invested. So there is no asset or liability on the balance sheet. The defined benefit plan, like ETSU still has. Other corporations, very few have that anymore. They have assets, they have liabilities, and those have to be audited. Those pension plans are audited separate from their financial statements. Defined contribution, look how easy that is. If they're going to contribute, whether they're taking out of your paycheck or they're contributing, they're still going to record pension expense and cash for the amount that they're contributing for you. Now, the amount that's coming out of my paycheck, remember the payroll exercises that we did on the exam? Wage expense, and you had like a credit here for 401k payable for $5,000 or whatever it is, right? Wage expense up here, maybe $58,000. And you had all these deductions, and you had finally what? Wages payable, net pay. You had FICA, you had federal tax. All those are credits. Remember that? Well, that 401k AP, that's just going to be what? 401k withholding. When pay is going to be $5,000. Comes out of cash. That's separate. They don't show you that there, but that's what's going on. This is what's coming out of this is what the company's doing for you. This is what's coming out of your paycheck that's been withheld. 401k payable, accounts payable or payable. They do a very good job. That account and that account are the same. Defined benefit. Employee bears the risk of loss, concern the rate of return, all of those things. What's the rate of return? What if you change the 1.5% to 1.4%? All that changes the future actuarial assumptions. There's the defined benefit, much like what I said there at the beginning. Credits for years of service. What's your salary level? Is it an average of all your salaries, or is it the last 5 years? You know, Social Security, when they calculate your salary, I think they use, I believe they use 38 years, your highest 38 years. You're not going to work many more years than that, but if you worked 50 years before you filed for Social Security, now you can file when you're 62 to get a sizable reduction, probably 25% over full 65, and of course it's going to be more for us and you guys later. It's probably 70 years. But if they're taking the highest 38 years for this calculation for Social Security, because that's what they're doing, the years of service and then a percentage. They don't tell you what that is, but again, that's where I said the state of Tennessee is 1.5% times your highest 5 years times your years of service. But Social Security, I don't know what the factor is, but they use your highest 38 or 39 years. They average all of them together times your years of service. But that Social Security is a defined benefit plan, right? There's your employment year, the deferral period, retirement, defined benefits, retirement date, very complicated. It's what math majors, they get jobs making good money as actuaries. There's 3 different obligations listed in here. The only one that's relevant is PBO, projected benefit obligation. You kind of skip the rest of this. There it is. You're projecting what is the obligation for this corporation, for ETSU, for anybody. What is your projected obligation that you're going to have to pay out to these people as they retire? And it's based on what is their age now, what's their wages, what could their wages be in the future, right? When are they expected to retire? When are they expected to die? How much you're going to have to pay? All of that is actuarial assumptions based on projecting your benefit obligation. And so if you got a projected benefit obligation as a liability, you have to have what? You have to have planned assets, right? You got to have the assets to pay that PBO. That's why when you look at California, they don't have near the assets they need to pay out the obligation for their huge retirement plans they have out there. Tennessee does. And so that's what you're doing. Plan assets, PBO. You're comparing the two. Are you underfunded or overfunded? Sounds simple, but it gets much more complicated than that. So here's a chart that shows you why PBO is so important and why that's what's used for required by GAAP. All right, we'll have to go fast here. Service costs. There's a lot of factors here. Service costs. What's 1 additional year of service for employees? This is all going into your obligation, right? And for your plans. And all that goes to pension expense. Pension expense. Then it goes to the obligation. Prior service costs. What if you change the benefit? What if you're going to pay more or less? What if that 1.5 is now 1.51 or 1.49? Prior service costs. Interest on the pension plan, right? Effective interest rate, amortization. PBO has to increase to meet the expected future value of the payout. I mean, you're not putting in your books now what you're going to pay out later on without taking into consideration the time value of money, right? Going through this rather fast. That's a good slide there. Expected and actual rates of return on plan assets, 2003 through 2013. Look what happened in 2008, 20% down. And that's when they've invested in both stocks and bonds. You may see something similar with what's going to happen here in 2020, unless the market rebounds. I'll see a big decline. I think the S&P 500 currently is down 32% year to date. Hopefully it'll rebound somewhat before the end of the year. Maybe be higher than it is when the year started. Who knows? Doubtful. But that impacts all of these projected benefit obligations. If it's a defined contribution plan, you don't care about any of that. It doesn't matter. Unless you're the one holding the stocks and bonds in your account, right? Defined benefit plan, the risk is with the employer, not the employee. People getting their Social Security check, they don't worry about what happens to the stock market. People retire through TCRS, they don't care what happens. They're grandfathered in. If something happens, they'll take it out of people who are still working. Like they started on July 1 of 2014. You know, interesting enough, when I was working in that kind of stuff at First Tennessee Development District here in Johnson City, small company, but I used to really get involved in the pension stuff there because we had both defined benefit and defined contribution. And I remember when that came out in 2016, I believe it was 2016, the state changed their future expectations for returns in stock market and bond market to 4%. That should tell you something. I mean, they were looking ahead even then of how overvalued the stock market is. So what you're seeing now, people are fearful of it. It's just they're fearful that it's dropped 32%, which dropped 32% from a level it never should have been at to begin with. mean, the S&P got up to 33.90, and now it's down to 23.05 or something like that. I would argue it's still overvalued. But people don't see it like that. It's like once you get something, then that's where it should be, right? But that's not how financial systems and the stock market works. There's always periods of where you're gonna have reversion to the mean, meaning it's been above the mean for so long, it's reverted to that. What did I say? 6.5% is the expected long-term return of the stock market. State of Tennessee, in 2016, is expecting 4% return. A lot of BS out there, believe me, of stuff that you see on TV, especially on financial stuff that really scares people, and really a rational person, you can figure it out for yourself. What has value and what doesn't. All right, so you have gains and losses on these plan assets as well, don't you? That's what they're showing you back on that other chart. I have talked too long. Don't worry about the corridor approach. Michelle talks about pensions quite a bit in advanced accounting, so there are a couple exercises in Pearson that we'll look at next time. You know, a big part of that is factor 6 and factor 7. How do you fund a plan? You got to put cash in there, don't you? In your plan assets. And at the same time, you got your payments coming out of that on plan assets, as well as your liabilities going down as you make those payments. That's the one thing, payments to retirees, that's the one thing coming out of both the PDO and the plan assets. Makes sense? Here's a good example, how they funded $100,000 of pension plan assets out of cash. And there's the payment of plan assets, right? I'm reducing plan assets, I'm reducing my obligation as I make these payments to my retirees. Very complicated. Disclosures, disclosures, disclosures. I believe that is all. All right. So I'll put another video for the homework at some point. And I hope you have a good day. If you have any questions about any of this, feel free to email me and I'll get back with you as soon as possible.